And now, broadcasting from Titletown, USA, here's Joe Simon.
We're talking about life insurance today, and before you take a big yawn, I think this is going to be interesting. The news is out, and what we know from last year and following this closely is that we've got some concerns in the life insurance world as it plays into you and I and our citizenship here in the United States. LIMRA reports that 41% of Americans either have little to no or inadequate amounts of life insurance. Think about that. That's a financial infrastructure in our households throughout America. We're going to visit that today and address some questions that people that really want to know a little more about how life insurance works. And maybe you're someone watching today saying, that's me. I have just what my employer offers, and that's it. And it's not a lot. And we need to make some decisions, and we need to understand what we need to do before we make those decisions. That's what today's show is about. If you're somebody that has all the answers and knows this and has done that homework, guess what? I'll save you some time. You don't need to watch today. But if you're somebody that's saying, I did this one time, I visited it one time, but I still don't really feel like I understand what we need to do for me and my household, this is for you. So here we go. We talked about the shortage. We talked about what's existing here in the United States. What's interesting about that is when we look at what's happened in 2024, as far as life insurance sales, kind of a current, kind of a pulse of what's going on out there, we see that life insurance sales has increased by 3%. The number of policies that were sold last year, purchased, was actually down. I'm not sure that's too concerning because really the upside to that is it appears that Americans are buying bigger policies, just not more policies. Something to think about as we sort of put this equation together of life insurance and the environment that we're seeing out there today. The last part, as reported by the Social Security Department and the Department of Labor, is that 80% of Americans from 2024 report that they earn 60,000 or less in annual income. 80%. 80% of Americans earn 60,000 or less. I had to repeat that. So that means there's a very good chance that that's somebody I'm talking to right now. And oftentimes when we watch the financial shows and we read the articles and we listen to people talking about their $1 million 401k policy or 401k uh, accounts, uh, we can often feel like we're the only ones that don't get it, that don't have that. Well, I think the numbers are talking to us, wouldn't you say? 80% of Americans are earning 60,000, and the cost of living today continue to move up at 2 to 3.5%. So I think there's a lot of us in the same boat, possibly, let's say that, kind of creating one big happy family here for today's little conversation. And that's the way we're going to approach this life insurance equation today, with that in mind for you, the 80% out there today. How's that sound? All right. Well, let's walk through this together. I came up with a couple bullet points, 5 or 6 of them, that seem to really make sense as we look at this. And it's kind of a reminder for some and maybe uh, uh, new, for lack of better terms, when it comes to looking at what life insurance does, the chassis, the makings of the policy. First of all, the life insurance policy is something that I just find fascinating. You apply for a policy, you have a certain dollar amount that is agreed upon by you and the insurance company. The policy's then issued, and let's say for a few $100s, there's thousands, possibly $1 million or $2 million. It depends by case. But that life insurance company goes on the hook to pay. Basically, it's pennies for dollars. The only thing you're on the hook for is making the premium payments. What they're on the hook for is at your death, because it's your policy on your life, they pay the death benefit. It just, it sounds very simple. And I know you're saying, well, I know that, but I don't think sometimes we take enough time to think about that and what that does for the next generation. If you're a business owner, for the survival and the increase in growth eventually in that company. These pennies for dollars contract that were arranged in many cases many years ago. I don't know if you've ever talked to somebody that's a recipient of a death benefit like that, but it's kind of, you can tell in their eyes, it puts them in awe that it really did what somebody planned on doing several years ago. That's why we're having this conversation today. It's an awesome discussion, this life insurance contract. So let's talk about those bullet points I wanted to address quickly. Life insurance premiums are paid with after-tax dollars. We're not going to be able to take a tax deduction in most cases. There's specific, very unique situations that would contradict with that. But 99% of the time, the dollars used to buy that life insurance policy are after-tax dollars. And that's a good thing. Remember the pennies for dollars equation. The pennies for dollars because the death benefit is tax-free. It's pure and simple, pure and clean. It's a flow through of after-tax dollars, and the dollars that come back to the beneficiary are tax-free. Awesome. Number two, tax-deferred cash value accumulation. In a permanent life insurance policy, we're putting money into this policy. It's including the cost of the life insurance, but it's also including accumulation. And there's various types of policies. We're not going to talk about that. That's for another podcast. But we've selected a permanent policy that's going to show us some growth, and we'll know that heading in. And every year that we visit and review that policy. But the awesomeness in this tax bubble is that the policy grows and there's no tax reporting that takes place like you would have in your brokerage account, for example. That's a non-qualified brokerage account. The money accumulates in their tax free as long as we don't break that tax bubble. And that's called the policy. It's first in and it's first out when we're borrowing. So it's tax after tax dollars in this policy, right? There's one thing in this that we have to be aware of, that we can't stuff the policy beyond its capabilities. And there's something put in place years ago called the 7-pay test. The 7-pay test is a speed bump that says I can't come in with $25,000 and stuff a $25,000 life insurance policy because it's not built to hold that. I'm driving it too fast. There's a multiple that'll take place, and it'll probably be a large amount of life insurance that I'll need to buy for that $25,000 initial premium. Large, 5, 6, 7, $800,000 possibly. It's a large multiple, and it's not going to be close to $25,000. Well, what if I have an infant? What if I have a 2-year-old that I want to do this for? Same answer. It's going to be a large death benefit without it becoming a MEC. MEC policies aren't a bad thing. Modified endowment contract. I have clients that understand these rules and still want this because of the tax benefits while the money's in there, but just know when the money comes out, it will all be taxable. So in the purest sense, what we try to do is have a policy where we won't have the MEC consequences. We won't have the overfunding that the 7-pay rules are set up for us to abide by, the speed bump. We'll have a pure life insurance policy with that $25,000 in, and we won't have to deal with any taxable consequences in the end on that growth. So that's a beautiful thing. That's amazing. As I said earlier, and this is my bullet point number 3, is FIFO, first in, first out. Money, the premium you're putting in is the first money in. When you show up someday and you say, I want to borrow some of the cash value, which is a beautiful thing that many people consider, or when they find out, they go, oh my goodness, I have another avenue of my money that's been taxed. it's non-taxable. So we get in there and we can look at what amount of that first in money in that premium, that premium that's in the policy, can we pull out? Could you use something like that in your lifetime with no tax consequences or penalties? Think about that one. That's one of the beautiful, amazing, or awesome, I'm using the word awesome today, awesome benefits in these said policies. Tax-free death benefit. That's my number 4. So what happens there is I have $1 million life insurance policy, and my wife is the beneficiary of that $1 million policy. I keep paying those premiums. I haven't lapsed. The policy's in place. Everything is built the way it should be. And then I die. And my wife goes to the funeral, and sooner or later she realizes, and she knows there's a policy. The policy pays her tax-free $1 million. $1 million tax-free to my wife. Or you're somebody that says, I don't have a spouse, but I have kids and I have grandkids. And by the way, the kids don't need the money. They're doing great. But I love my grandkids. They're special. Love my kids too. But my grandkids, they're special. Wouldn't it be interesting to do something tax-free without those tax benefit issues, without the required minimum distribution issues that we have in our IRAs, without the capital gains issues that we have in our brokerage account, non-qualified brokerage account? We move the money out, we got to pay taxes. Wouldn't it be interesting to take that $1 million death benefit we're talking about here today, making the grandkids the beneficiaries equally, and they receive them tax-free? Well, we don't have that kind of money to throw around. I understand what you're saying there, but what I'm saying is, in this case, play with me. We're talking about $1 million of life insurance that could be divided up amongst your grandkids at your death. And this is the way the beneficiary status is written in the policy, formally written and received and confirmed. It can't be just words. Or better yet, having an attorney draft a trust that the policy is deposited into, and with proper amount of time, then at your death it pays out. One concern we have to be aware of is if you die after you set that life insurance policy into the trust I just talked about, it needs to be in there for longer than 3 years. Otherwise, we're going to have some estate tax issues come up. So just be careful if you have an existing policy and you're going to change that beneficiary from your ex-spouse, who shouldn't be on there any longer, right? Unless there's some kind of divorce decree. So we want to make sure that's right. But then we're making the move to who the next beneficiary is, and you have minor grandkids, let's say. The trust would be the most beneficial way to do that. You can control that from the grave, so to speak. But if that 3-year rule concerns you, then the next best way to do that might be to have your grandkids all listed as beneficiaries on this policy, to make sure that there's a direct A to B movement, death benefit from the insurance carrier to your grandkids. Those are discussions to have with your advisors. Just don't run off and do that on your own today because you heard this. There's other discussions that have to take place before you make a move like that. But there are beneficial reasons you do that, right? So I think the last part to this is when a life insurance policy could become a taxable issue. And it's one of those is, like I just stated, we set up a trust quickly and we think we're going to move this death benefit out of our estate because it's set in this ILIT, this irrevocable life insurance trust. Many people have heard that, but what we have to be aware of is that 3-year rule. We just discussed that, and how those beneficiaries are set up in the right manner. Tax issues that could be around that if it's not done in a timely and legal type of way if we're moving into trusts. So the last thing I want to do is let's sum this up today. Let's take a minute quickly to sum it up today. And I just jotted it down. I want to look at the bullet points. There's about 5 of them here today. So when we talk about life insurance, the funding contributions that exist are really non-existent. We have the 7-pay rule we talked about, but it isn't like a 401k that you're trying to put a lot of money into, and there's a ceiling that we can only put into that. Or an IRA, there's a certain amount that we might be eligible for to put in annually. That typically isn't what we're finding in life insurance. If you have a lot of money and you're willing to buy the big policy with all of that money, and you can be insured for it, you're insurable for it, there really is no limit for you. How about the tax deferred accumulation? There's tax deferred accumulation for as long as you want to drive that policy. There's no limit. There's nothing there that says you had this policy for 50 years. You have to break the shell and the egg spreads out on the frying pan, and you got to pay the price for this this beautiful thing that's been accumulating, the cash accumulation in that life insurance. There's nothing that says we have to do that, like in your IRA with required minimum distributions. That's fascinating. How about tax-free distribution? We just talked about FIFO. We can go in and pull money out that's been put in first, pull that money out on a borrowing avenue that keeps us tax-free from that. And we can continue to pull that money out, that all of that accumulation, as long as we don't cancel the policy and the policy doesn't cancel itself because we've sucked all of the cash value out of that. So there's nowhere that they can go to pay the cost of having that life insurance, that death benefit, that mortality cost in there. Again, a specific conversation you have to have with your qualified insurance advisor to make sure that the right moves are being made at the right time, beneficial moves. Here's another one, tax-free death benefit. We talked about it. Life insurance death benefits are tax-free. There's different situations, but what about this? What about that? Tax-free money going in called premium. A to B movement of money to the beneficiary, let's say your spouse, let's say grandchildren, let's say children. The money goes from the insurance carrier at your death to your beneficiaries tax-free. Awesome. Lastly, early withdrawal penalties. There are no early withdrawal penalties in these life insurance policies. We have to make the promises, be good on the promises made to the insurance carrier, that is, pay the premiums in a reasonable period of time, and they do their thing. Pennies for dollars. Joe, you didn't talk about the various types of policies today. That's for another day and another time. Very interesting discussion. This is a very fluid industry today. And just think about this. This is the walkaway today. The pennies for dollars over the years that Americans have sent to insurance carriers, and they've made good on their promise of paying multi-millions of dollars to Americans that have helped families, family farms, children, grandkids, businesses. It's an awesome tool. And let me say this, life insurance is not an investment, and investments are not life insurance. I would love to have that debate with you in the future. But in the end, I'm going to win. Life insurance is life insurance. It has those other add-ons, right? But it's not meant to be the life insurance horse versus your stock brokerage account. Two different horses. Can't run the same race. So think about that. Have a prosperous day. As always, I'm so glad you joined me today. Have a great one.
You've been listening to the Joe Simon Podcast. Big ideas with powerful stories and real-time solutions. Business succession planning, executive benefits, employee benefits, tax beneficial savings, and more. Remember, information discussed here today is dated and not specific to your situation. Always seek personal counsel from qualified advisors. For more about Joe Simon, go to DaVinciInsurance.com. Joe Simon is a licensed insurance agent in the state of Wisconsin. Licensed to advise on accident and health, life insurance, disability insurance, and annuities, as well as qualified long-term care insurance. Make sure to visit the DaVinciInsurance.com archives for more of our podcasts.